today's hot sheet, I'm discussing Ivy Zelman's insights into the 2025 spring selling season, Fannie Mae's economic development report and their housing report, Trump's gold card, what that might mean for home prices in the luxury sector, as well as this week's mortgage applications. Today is Wednesday, February 26, 2025. I am Byron Lazine, and the hot sheet starts now. Good morning. Welcome into today's hot sheet. Let me know in the live chat which market you're tuning in from, and let me know in the live chat if you'll be joining me today, 3 p.m. Eastern, on the BAMX live office hours, where I'll be taking your objections and working through live role play together. That's for BAMX members only. Join us over at bamxschool.com/BAMX. We have switched over to School, the #1 education and community platform in the world now. That is their ranking. And there's no more Facebook spam. So the community is all in one place. You can go to the calendar here and make sure that you add to your calendar today, 3 o'clock Eastern, live role play with myself. You also get access, obviously, to all of the hot sheet, everything that we're going to go through today, all of our live slides, how we make the cake, our hot sheet show notes each and every single day is uploaded into the hot sheet classroom. So much going on here today. Ivy Zelman, if you've been a fan of the hot sheet for since its inception, this show, which is live every Monday through Thursday, that markets are open, 9:30 on the East, 6:30 on the West. It's the only 24-hour look back on housing. If you've been a fan of this show for any period of time, if you've been part of this hot sheet community, you know how I feel about Ivy Zelman. You've seen me share this tweet from the late, great Steve Harney about Ivy Zelman multiple times. It's an Ivy Zelman quote. We would never suggest that a real estate company could be successful without fully understanding local market trends, but ignoring macro trends or assuming they do not carry the same weight would be an equally erroneous suggestion. In our experience, the most effective industry leaders, plug-in real estate agents, appreciate the appropriate balance between the two ends of the spectrum. You need to know what's going on in the macro. That's why this show exists, to sift through the BS for you and then relate it down to the micro. And so you know how I feel about Ivy Zelman. If you're new to the hot sheet, if you're just getting into the hot sheet this month, this February, this year, 2025, Tori, appreciate you being here from the start. Love that. Thank you so much. It means the world to us. If you're new, if you're 2025 new hot sheet, let me know in the live chat. I'd love to see how many new members of the hot sheet community that we have. By the way, if you're new, make sure you hit subscribe and the notification bell so you don't miss anything. But I feel so when Ivy Zelman speaks, I listen to everything. She barely gets out there. She was one of only 3 analysts who saw the great financial crisis, the mortgage crisis of 2008 coming. She called it way ahead of schedule. She didn't call it in the 9th inning. She saw it before the relievers started warming up. She knows what she's doing. And so when she drops information, I tend to listen. I tend to share it with everybody here. And right now, her headline here recently on CNBC, we're going to get to some of her comments here. Why? The headline is the spring selling is off to a slow start and it's impacting home builders. The question is, and what we're going to break down is it really impacting the agents who are in the game each and every single day? Okay. Is it actually impacting sellers who want either price or preferred timeline? You could argue in some high inventory areas, Southwest Florida, price is certainly being impacted. I see Tori from Tampa. Tampa's the only metropolitan area on Case-Shiller's 20-city composite that's down on price year over year, albeit just at 1%. They've had incredible boom years. So you carve off 1% on the overall, it's not a big deal. But there are sellers who are feeling it in areas like that. But in majority of areas, are sellers really impacted by this slow selling season? Or is it more similar to last year? I want to see what Ivy says. Her data, her analysts on this is more important to me than almost anybody, if not anybody. So let's get into the impact on builders first. Go to the 36-second mark here, and let's hear from Ivy on the headwinds, what's slowing builders down right now.
With that said, though, you have risk of inflation from tariffs. You've got deportation risk, which is certainly a concern with respect to construction workers, which could put more inflation in labor. And then you now have, softer overall job growth with respect to federal layoffs. And, you're definitely have a wall of worry. And builders today do not have pricing power. They're offering concessions. So if they have higher costs, and certainly they have higher land costs that are running through the P&L, that's going to put margin pressure on them. So if your investors are saying, why should I own these stocks? Now, rates coming down will help. And some of the companies are doing better than others. So I think that the Toll Brothers earnings got everybody thinking about where the spring selling season is going. And right now it's not a disaster, but it's off to a slow start.
So then
okay. So one thing Ivy said there was, that some builders are doing better than others. Builders are competing against other builders, but they're also competing against existing home sales, where you can argue existing home sales are competing against new builds in these new construction developments, but a lot of buyers are either going to pay the premium for new, or they're like, I'm really trying to look for a particular area and there's not new, or I want to be in a certain community and there's not new builds happening there. Or I want a price point of existing and kind of put in maybe my own, fixer up or something that's been renovated in the right community. So, while home builders have to compete against everybody else and the existing options, if they've got the right location, the right community, are not necessarily always competing against new construction, against new builders. And builders right now have over 9 months of inventory, where existing home sales have 3.5 months. So it's a much different supply dynamic for builders versus existing home sellers. And let's be frank here, builders in every market have just built up, in almost every market, I should say, have almost built up to like where that above median, above average price point would be. And that's where you're seeing some of this stay on the market for longer. They're obviously dumping some serious supply onto the market. But if the price points were more affordable in the markets that they're building in, then you wouldn't see this amount of months of inventory situation that you do with builders. So they're also feeling it because of that. And they are having to compete with each other on these new concessions. Let's go to, she mentions that investors are questioning whether they should hold home builder stocks. Toll Brothers is the preferred long play. But let's go to 2:12, Haley, 2:12 timestamp there. And let's dive into the luxury market and where Ivy Zelman sees luxury market, which we've seen huge growth in, 29% more sales over the last 12 months in the higher end market. How does Ivy Zelman see it today?
Ivy, given the overall environment, and given, I feel like at least for the past 3-4 years, we've been like, well, the rich will bail out this company or the economy, et cetera. Is luxury a safe haven? Can you buy Toll here and feel like it's not too expensive where you're really exposed still to significant further downside?
I think buying Toll here fundamentally because of their customer base does make sense, but because of the way the group trades, they trade as a group, it's difficult to see Toll outperforming today with respect to, a lot of those uncertainties I mentioned. So if you had to own a name right now, I would buy Toll.
So what's the counterintuitive call?
So she's saying, hey, if you're going to pick a home builder stock, build Toll because they're building luxury market. We've seen that grow 29% more luxury sales over the last 12 than we've seen the previous 12. So the luxury buyer, not impacted by rates as much, not impacted by inflation, not impacted by some of the other things that she said in this commentary that have her concerned here, would be risk of inflation from tariffs, deportation risk, which is a concern with respect to construction workers, It could put more inflation into labor. So see, these are some of the things that she sees as issues, on this, or a cloud kind of hovering over this spring market. But let's go to 253 here and finish out the rest of how she's looking at this spring selling season.
So what's the counterintuitive call in this situation? I guess, is there something that moves counter to overall these home builders that investors should be thinking about if they're thinking about hedging?
Well, if I understand your question correctly, you're asking why they would own them. What's the bull case? Is that what you're asking?
No,
Jeff?
I'm really wondering if there's a particular home builder or something else out there that you see, that you watch, where if the home builders are doing well, it's not, or if this thing is doing well, maybe it's a sign that the home builders are in trouble.
Well, I think that the home builders, the ecosystem we have, whether it be real estate brokers, mortgage companies, multifamily operators, single family rental, I mean, the whole ecosystem right now is under pressure. And I think that today it's very difficult to think that the building product companies that we also follow are going to have pricing power to pass along the higher costs associated with tariffs to the builders that are going to push back. So I don't think there's an alternative area that we're really excited about.
Wow. So there you go. That's how that's Ivy Zelman, one of the most brilliant analysts in real estate, not identifying a certain sector. She named real estate brokers, mortgage companies, multifamily operators, single family rental markets that are facing challenges right now. And she's not particularly excited about any of them as a sector. So she's proceeding with caution. What she's not doing is calling for Steve's question here for the purpose of discussion. Where does the price point of luxury housing actually begin? Redfin defines it as top 5% in a particular market. That's one way to look at that. Every market can be a little bit different, obviously, but that can be used as a rule of thumb. Like the top 5% sales, that's kind of where luxury, would be defined as. You could widen that. Certainly, it really kind of would depend on market, right? I mean, $1 million in the market that I'm sitting in right here, Naples, Florida, isn't going to be considered anywhere close to luxury. Where $1 million home in the town in Connecticut that I own a home in, you're starting to get into luxury there, because there's just not a lot of sales in that particular town that are going to break $1 million. There's a handful, there's 20, but it's not going to be a ton. It's going to be closer to that top 5 or whatever, top 10% maybe in that particular town. So it's town by town specific there. So Ivy Zelman is just to wrap up here. She's not super bullish on anything, but what she's not saying is stating an extreme bear case. She's not doing what she did, before the great financial crisis and saying, hey, we are headed, into a major crash here. She's not saying that. She's saying that there's pressure. They're not excited about 2025 in any particular way. Now, on the flip side of that, anecdotally, I see a lot of excitement happening with the agents who are really invested and investing in their business. I see Kim jumping into the live chat here, where I think it was one of Kim's previous comments, actually, where she's got a new listing going on in 14 offers. Okay, there you go. 14 showings. Sorry. 14 showings on a listing in Charlotte. I see a lot of agents invested in the day-to-day right now, invested in clients' journey, in investing in their business. Think top, percentage of agents in any given market who are very excited about the spring. That warm weather yesterday north, all of a sudden, like I heard a lot of agents yesterday popping deals. Again, anecdotal evidence, but like the sun peeking out in the north makes people feel a little bit better. Things are happening. A lot of this is consumer confidence. And so, just like last year, there was agents that had their best years. Okay. There was investors that had great years. And it's far and few in between on the investor side. I get that. But there were big years last year in a market that certainly had significant pressure on it. This year is going to be maybe a little bit better than last year, but similar to it. That's what these early innings are telling us. And so as a sector, as an overall, I get where Ivy Zelman's coming from, not super excitable. This isn't 2021 where you see champagne popping every direction you look. It feels like there's closing tables everywhere you go, whether it be Starbucks, your office conference room, or your own dining room. There was closings happening everywhere. We're not at that level of sales, nor do we be expecting to get anywhere close to that. But there is still gradual improvements that we are seeing. It's slow. Okay. An iceberg doesn't melt overnight. It takes decades for this market, this low interest environment to thaw out. It's going to take time. All right, let's jump into Fannie Mae. They have their economic development report now just released. And with that, we get the housing forecast table. So just jumping into I want to see, this is their February report on how they're looking at their projections versus where they were looking before. Okay. They're like for GDP right now, their GDP outlook is 2.2% for Q4 in 2025. And it's only modestly revised. More importantly than that, I want to really pay attention to where have the adjustments come on their housing outlook. And we're going to dive into that here in just a second. Remember, yesterday I talked about Realtor.com. I mentioned the podcast that I did with Lisa and Tom on Knowledge Brokers with Danielle Hale, the chief economist at Realtor.com, that we did on Friday, where Realtor.com puts their number out for the year and they stick by it. They may make one adjustment, they may not, but they're still calling for low sixes by the end of the year on the 30-year fixed. This economic report, Fannie Mae, that we're going to look at, it gets adjusted and they show us those adjustments each month. So they're taking in 30 days of data and they're making those adjustments. Now, Danielle Hale, since that podcast, yesterday's 30-year fix, I think if we're going to pop any champagne, we're now trending at a 4-month low, getting close to it on the 30-year fix. That's great news for everybody. It's great news to potentially create a little bit of a tailwind. We'll get into mortgage applications a little bit later, but first, let's dive here into the Fannie Mae. I'm jumping into BAMX. BAMX members have access to all of this data, and you can just download this stuff right here, make it easy for you to sift through all the stuff that you don't need and give you the stuff that you do need on a day-to-day basis for text messaging and email newsletters and what have you, communications, maybe sitting in front of a client at a tour and pulling this up on your phone in real time. Here's how Fannie Mae's thinking about the 30-year fixed. Okay. Their prior forecast, okay, was in the mid sixes, the upper to mid sixes throughout this year, and then not really getting into what we would consider 6.25 range until the end of 2026. That was prior. Their current forecast, they've moved it up. Okay, so we've seen some momentum here the last couple days. We ended the day yesterday at 6.8. That's trending near a 4-month low on the 30-year fixed. What Fannie Mae is saying, they actually feel worse about forecasting out 2 years on the 30-year fixed than they did 30 days ago. And 30 days before that, they continued to feel worse, I guess is my point, each 30 days. So they keep updating forecast and it keeps getting worse on the 30-year fixed mortgage. So when they're looking at the last 30 days of data, the information that they break down, the way they break it down, they're not as bullish on the 30-year fix getting low anytime soon. They've got us in the mid to upper sixes the rest of the year going forward. So that's where we're at right now with the 30-year fix on how Fannie Mae is seeing it. Now, getting into their existing home sale report, we have a prior forecast that was showing existing home sales actually taking a steeper dip than where they're currently at. So existing home sales for what looks like this spring 2025 season, they've actually improved that here with the last 30 days of data. Now, they're a little bit less bullish as we get into the second half of 2026 than they were prior. They've got us, though, ending 2026 at a 4.5 million run on existing home sales. Right now, they still have us kind of where we were last year in that 4.1 million range, and then ending the year up closer to 4.344 on a seasonally adjusted annual rate. Moving back onto their next housing projection here versus their prior forecast, we have new single family homes. So what Ivy Zelman was really focused on with our conversation on CNBC, new single family home sales, seasonally adjusted rate. The prior forecast, much more bullish than the current forecast. So in line with some of the concerns that Ivy Zelman had on new home builders. The Fannie Mae is projecting less new single family home sales, not just in this spring season, but over the next 2 years, okay, based off of where they were on their prior forecast. So Fannie Mae, last one here would be single family housing starts. So how many builders are going to be starting homes? They've got their current forecast up a little bit here in this early spring season. But once we get to the second half of this year and into 26, they have those numbers down versus their prior forecast. And then single family mortgage originations, purchase and refinance. The dots represent on this chart the prior forecast. So purchase and refinance, purchase applications all down a little bit on the current, and refinance also down. So they're seeing less single family mortgage originations into the future versus what they were seeing on their previous forecast. Most of these are flat, but that's where they're at on that currently here over the last 30 days. All of that data obviously available for you to just grab simply inside of the hot sheet, market data, slides, articles, classroom here on BAMX. You also get access to our hot sheet show notes each and every single day so that you can see exactly how we make the cake, format your own shows exactly in that same way. It's all available for our BAMX members right there on bamxschool.com/BAMX to grab that. All right. There might be some people living in other countries that want to grab this new Trump gold card. Okay. Trump's floating out a $5 million gold card as a route to U.S. citizenship. Now, this guy on the right here, he looks pretty excited about it. I don't know if RFK Jr. looks excited. He might be taking a nap back there as the president speaks the day he signs the executive order, yesterday being in the Oval Office. This gold card. Okay, so what is this gold card? Is this more spaghetti against the wall, or is this something that actually might happen? And if it does happen, when you think about, inbound migration, think states like Florida, Texas, where they've experienced over the last 5 years high inbound migration, just people moving from state to state. What's happened to those economies? They've excelled. They've expanded. Okay. What's happened to home prices there over the last 5 years? They've expanded greatly. Even before COVID, home prices were expanding in places like Austin and in Florida because of the inbound migration that they were experiencing. So as a country, if we're going to have inbound migration, particularly migrants that are paying $5 million to gain U.S. citizenship, what might that mean for the U.S. housing market? So this was yesterday, floated the idea of replacing a visa program for foreign investors on a so-called gold card. Okay, he likes gold, so no surprise there on the branding. Now, somebody that wants to gain citizenship, who wants to basically cut the line, I guess would be the way to say it, and get into America and get going and gain citizenship, would be able to pay $5 million. We're going to be putting a price on that card of about $5 million. It's going to give you green card privileges, plus it's going to be a route to American citizenship. And here's the punchline here. Obviously, $5 million, you got to be wealthy. Wealthy people would be coming into our country buying this card. That this will be coming out in about 2 weeks. And so what are the benefits that President Trump outlined? That people would be starting businesses, potentially hiring, spending money, paying taxes on anything that they do business-wise in America. If you're going to pay $5 million to get in here, there's probably a reason why you badly want in here. The other thing that I didn't think about, which I actually think is maybe the most interesting, is that you might see, there's been big tech companies that want to retain somebody who went to one of our universities here in America, but yet they're not a U.S. citizen. They're maybe number one in their class. Trump always brings up Wharton School because I think he went there. So he used that as an example. You get number one in the class at Wharton School, but they're a resident of Sweden or some wherever, and they can't become a U.S. citizen. And so then they go work for, a company that is not in the United States of America. This does happen all the time. There's a podcast I listen to, All On Podcast. These guys are all, three of the four on the podcast are billionaires. They're all tech startup guys. You've got, really just Silicon Valley, San Francisco minds always filtering in and out of this podcast. And they talk about this being an issue all the time, where some of the best talent isn't here in America because they just don't have citizenship. So Trump pointed to, you might have a company, an Apple or somebody else that would be willing to pay $5 million to recruit the best talent in. Think about it. If you're willing to give somebody a sign-on bonus to come to some of these companies, or you're willing to give them stocks that could be worth $20 million, maybe $5 million of that goes towards recruiting some of the best talent outside of the country. Now, how does this impact housing? Well, just like Ivy Zelman said, she's bullish on on Toll Brothers, for example, because of they're in the higher price point versus national home builders. Just like we saw earlier this week on a recent hot sheet, the prices, the 29% increase has happened in the highest price point, the million plus. That's where we've seen 29% growth of sales. We know that there's still a small pool of sales that happen there, but the growth has been astronomical compared to the other price points on home sales across America. If you were to start bringing in gold card holders, I guess what we'll call them, new migrants in at that level, what's that going to do to some of these luxury markets? It's only going to make them more competitive. They're going to live somewhere. You're not going to pay $5 million for a gold card and then, go camping until you figure out, or rent a, affordable house. You're not going to go rent affordable housing in Austin. You're going to go buy something. If you're paying $5 million for the gold card, you're going to be living somewhere that would be in that luxury sector of wherever you decide to live. So this could, if it were to happen, have some implications on those luxury markets, make it even more competitive. And for agents really kind of identifying where their business is now, one thing I do encourage every agent to do, with just the dynamics of this industry and everything else, is figure out ways and methods to keep increasing over time your price point. Don't give up the income that's coming in, and the majority of the deals are happening at certain price points. But where can you continue to tweak and improve to move into those higher price points? Because when it comes to home ownership, there's no question the disparity of the reality of where it's affordable and who it's affordable for and who it's not affordable for. The last thing I'll say about this is, the aspirational, like sellers have aspirational prices. The aspirational number that Trump threw out was they could bring in 1 million people on this gold card. 1 million people would have an impact on luxury markets across the country. No clue if this program ever gets off the floor, ever happens. And no clue if it gets to 1 million. If it does happen, if there's going to be that much demand for U.S. citizenship at that level, obviously time will tell. We've got a little bit more time and data now on mortgage applications. We have the data in for the last week. There's a CNBC headline out there today that's saying, hey, despite rates low, being at almost a 4-month low, you're seeing mortgage applications decrease. The demand isn't there. And so they're referencing a headline number. And that's where we got to be careful with mainstream media headlines in general. Mortgage applications on the headline did decrease 1.2% from the week earlier. This according to Mortgage Banker Association's release this morning. Okay. That does, though, include refinances. And the refinance index decreased 4% from the previous week, although it was 45% higher than same week 1 year ago. But here's what we want to pay attention to, because this gives us insight to the home buying the spring season. This is more important than what we're seeing here with the refis mixed in. The seasonally adjusted purchase index was flat. Okay, it increased 0%. It was flat. It was moved sideways from 1 week earlier. Okay, now it was 3% though higher than the same week 1 year ago. So a little bit higher than what we saw a year ago. And according to Mortgage Banker Association, purchase activity overall is up 3%. Okay. So that number there is, to me, more important. I'd like to see week to week shifts up. And I think that next week we will, because while CNBC is saying, hey, rates are down, we haven't really seen that until the last couple of days. So that data is not fully baked in. If we see an end of the week here this week at the rate that we're at right now, 6.8, well, then we've got something to talk about next week. Did we see an increase in mortgage application? I would expect if we stay around the 6.8, 6.75 range that we just experienced yesterday for the rest of the week, I'm going to come in next week, a week from today, expecting mortgage applications to be up. Here's your mortgage application index on the overall. Yes, low. We're still at the low levels overall we haven't seen since 1995. These are lower levels on mortgage applications than 09, 10, 11, 12, 13, 14. So that is the reality of where we're at. Still a long way to go. One of the reasons why you're not going to see somebody like Ivy Zelman get overexcited about this particular spring selling season, while there still are, to me, a lot of good things happening, and we're going to count on those. As the top agents they're going to find those opportunities inside the market. Yesterday was an opportunity day for those that shared it with their clients. The lowest 30-year fixed on the daily survey in about 4 months, 6.8 there on the 30-year fix. So exciting to see where this brings us today. The 10-year is still kind of in line with where we were yesterday. We haven't seen much movement. This is the low spot, about 4.3 over the last 5 days, the low spot in the last month. And this is trending towards the low spot on the 10-year in the last 3 months. We have seen the spread improve, which is why we can claim the low spot there on the 30-year fixed in that same time frame. Haley jumping in. What did you need something, Haley?
Sorry.
Are you
it was
good?
an accident. Yeah,
Accident from Haley. All right, we will let her slide. I thought you were trying to get me off the YouTube air here. So I want to wrap with this. This is in the Wall Street Journal today. The economy is still fine. Americans are still gloomy, though. Okay, so Ivy Zelman, not excited about the spring market. I know a lot of agents that are in the top tiers of the business that they operate, the micro market that they operated in. The top agents might be excited, but then there's still probably a lot of agents that are gloomy about this spring. And so we need to understand all aspects. The economy is still fine, but yet Americans are still gloomy. This also supports like that high end is totally fine, but your average American is still just not feeling, the kind of energy or confidence that they want to feel. Like, you never want to say, hey, could you write me a review I sold your house, I sold your mother's house last week. It was a great deal. Like, and could you write me a review based on your experience working with me? And then the review comes in and it's like, hey, Byron was quite fine. That was a good deal. Glad I worked with him. Like, fine. Like, you want outstanding, you want fantastic, you want best agent of all time. So we don't want to hear that the economy is just fine. That's not a great description of it. And Americans are still gloomy. Okay. So one thing that hasn't changed since November's election yet is that the economy hasn't shown much change and people are still really just not feeling it. As we go into our conversations, our consulting conversations, our work with clients here, whether you're an agent, a broker, a team leader, a lender, or any other segment of the real estate housing market, understand this about where people are at today, how they're feeling. Be curious about the situation that they're in. Every objection, and I'm going to speak about objections today at 3 p.m. inside of BAMX. Every objection is an opportunity to understand more, to dig deeper, to really see how they're feeling and what the true problem is that they're presenting you with solving. Not everybody is going to give you their cards up front. A lot of poker players they don't want to show their cards. Even if they're on a winning streak, they don't want to show the table what they've been doing. And consumers are going to be the same way. They're going to show you a little bit of the information up front until they can fully trust you. They're going to trust you with the details. Somebody who's detail oriented is somebody who's going to be super curious to find where they can attach their process, their details to those needs. So understand, consumers don't feel great across the board. Yeah. When we're talking about that top 5%, they don't feel anything because they're the top 5%. But the other 95%, you've got to get into the work, into the mud with them and really feel what's going on. Because just because your business is going super well doesn't mean your consumers are feeling the same way. So I'll leave you guys with that. I hope a bunch of you will join me today, 3 p.m. Eastern, inside of BAMX. If you're a BAMX member and you're not sure exactly where to find that, just go into BAMX, whether it be on the app or on the desktop, jump into the calendar, click on today's live role play. You can add it to your calendar right here. And I will see you guys over there, 3 p.m. Eastern, in the live role playing, live objection handling and role playing with me, 3 p.m. Eastern, 12 o'clock Pacific time, inside of BAMX, school.com/BAMX if you're not yet a member. All right. Until then, of course, toodaloo and have a great day.